All right, let's proceed. And as you have seen, we have gone through accounting for defined benefit plans, and we said that we'll have planned assets and planned liabilities. And in the statement of financial position, we usually show in them in the net value, do not show assets and liabilities separately. We saw that we would have opening balance, and since the contributions are usually paid at the end of the year, that means it will not affect this. We usually determine the interest component as the percentage of interest, that is the interest rate given, and this opening balance. And then after, during the year, there will be service. You know, when you have a liability or an asset, that means there is an kind of investment, or maybe you have to pay for something. That's why you determine the interest component. But when the workers are still working with you, or maybe they worked with you in the past, there'll still have be the service cost component that is here. Then actually you as the entity will make contributions into the plan like this, and maybe you also pay out benefits. So the benefits are usually not included here. So what we say is when you obtain this figure here, you will leave a space and then you come and compare it to the figure at the end. Usually the plan assets are measured at fair value, and the plan liabilities should also be at fair value, but you usually determine them at present value, right? So you take the present value of liabilities, you take the fair value of assets, you net them, and you obtain this figure here. And then you compare this figure here with this figure which you obtained under computation. And then the difference between these two figures here and here should give you the remeasurement component. That could be the remeasurement gain or loss. And this goes to the other comprehensive income, not to profit or loss strictly. All right, let us do this. Let us do this. As I said earlier, the reality is like this. The reality is you would have the plan assets. You'll have the plan what? The plan asset, but also you would have the plan liability, just like this. And here we have the net. It could be the net plan asset, or net plan what? Net plan asset or net plan liability. Now, maybe to make matters easier for you, let me just use the method they use so that it could be easier for you to study. They decided that the plan asset should have a negative sign, right? So whatever at the asset should be negative, whatever at the liability should be positive, right? Let me do it too. It's so in the statement of financial position, this is what we do. We just take the net, but you really have to know what the amount, how the amounts affect each other. So you'd have the opening balance, that could be the balance broke down, balance BD, right? Let's say maybe I have the plan, maybe let me put it into figures, it would be fine, right? Let's presume that I have the plan assets of 1,000. I'm just presuming. And maybe let me do it, let me say 100. And maybe I have the plan liability. Let's say my plan liabilities are only 140, right? So if you do this, you will find out that, oh, I have the net plan liability, right? Net plan what? Liability, because 100 plus 140 gives you 40, and the net is on liability side. And then you have the net interest. They just say net interest component. We need the net interest, but we believe that they have already been netted like this. But in case they are not netted, let's just presume maybe we have the interest of 10%. It's just a presumption, right? 10%. So I would say 100 times 10%, and this should give me 10. And then I would come here and say plan liability. Okay, 140 times 10%, that should give me 14, like that. Oh, 14 should be positive, right? We said the liability is positive. So negative 10 plus positive 14, you would have positive 4, which I think you can find now. In case we are only using this figure which is required, I would say 10% times 40, which will also be 4. But also I need to specify something. You really need to go where this goes. Net interest goes to the statement of profit or loss, right? Yeah, that's where the net interest should go. So you really need to know that too. Let us deal with this completely. Okay, so I would have something like this, like this, like this. All right, let's proceed. Now, as for other components, I could have something, say, we have something called service cost component. And for service cost, first of all, this is the net liability. Either a liability or an asset, if it involves investment, it would incur interest or an interest. That's why I have net interest. Then for service cost, this service cost will come and realize later that you can have current service cost but also you can have past service costs. Don't worry about this for now, but all you need to know right now is that they are both taken to statement of profit or loss as usual. So we can also say here, goes to profit or what? Profit or loss, just like that. Okay, so let's say that the service cost component increases the liability, so it would have no impact on the plan assets, but rather it would increase the plan liabilities. Now let's say they give you a total of 20 or maybe a total of 30. So a liability would increase by 30. Actually, 30 minus 0 here is it would be 80. So that's why we said the plan liability just stays here at 30, right? Okay, we could have something also called contributions. You know, an employer would make contributions into the plan, right? Contributions. Now, if you make the contributions into the plan, actually you expect contribution to be in form of cash, right? Yes, you expect it to be in form of cash. So let's say it has been in form of cash. So we expect it to go to the statement of cash flows, right? In case you do prepare that. The contribution actually go and make an investment much bigger. It goes and inflate an investment, right? So let's say you have contributed 40 million, right? Let's say. So the asset, the plan asset is increased by 40 million, and the plan liability would just stay as it is. And right, and now the difference would just be it would be negative right now, right? Because it's all about assets. It would be 40 like this, right? Okay, now we proceed and say maybe there could be benefits paid. You know, this plan is invested in there so as to compensate the employees. So let's say that suppose you have decided to pay, suppose you have decided to pay 10 million out of the plan assets so as to pay the employees, meaning so as to reduce the plan liability. I would say, since the plan assets have a negative sign, if I pay 10 there, out of that, it would be 10 positive here, and then that 10 should be used to extinguish the plan liability. So since the plan liability have a positive sign, to reduce them, I would also have to write 10 there. So if you net them, 10 and 10 gives you nil right now. That's why you say in the books benefits paid should be none of your business, because if you see there is a nil value, even if they have been paid, that should be nil because we present the results in the net form, right? Okay, so this is what we do. Actually, we'll see other things here. You know, as for this service cost and as for this service cost, there are things that we usually like to improve. You will see it later, right? You can have, we have something, let me just write it down. We'll see something called settlement. Settlement gains, actually, let's just say etc. There are things that you will find out, but they are usually included under this service cost. So that's why I haven't seen. All right. So after that, you go and obtain the carrying amount, right? The carrying what? Carrying amount. And the carrying amount here, actually in the statement of financial position, you won't need these assets and liabilities, right? Just come to the net figure. Now say that the net figure is how much? It was 40 minus 40, 0, 40 plus 30, 34. It gives us 34 positive, right? Now down here we usually write remeasurement. It would be a remeasurement. We don't know whether it's a gain or it's a loss, so we'll have to see. Or we call it actuarial, because we said you need an actuary to obtain the value. And at the end, the balance CD. As for the balance CD, this is what we usually do. You do not just take this difference and say the balance close that down. No. Balance CD, you have to take the difference between, it will be the difference between fair value of plan assets versus present value of plan liability. And this one should give you that much figure. Now, suppose maybe, I'm just supposing, maybe the fair value of plan assets, maybe plan assets are worth how much? Let's presume that the plan assets are worth 80 million, that's the fair value, but the plan liability, maybe plan liabilities are worth how much? Let's say plan liabilities are worth 110. I'm just presuming. So I would say, oh, so the plan liabilities exceed the plan assets by 30, 110 minus 80. And this gives me 30. So I would have my 30 net in plan liability. So you can ask yourself, is this a measurement gain or loss? You had carrying amount a liability of 34, but at the end, its liability has reduced by 4, from 34 to 4. So a decrease in a liability is obviously a remeasurement what? Remeasurement gain. In the case it was a decrease in assets, it would have been a remeasurement loss. So this is a remeasurement gain, and this usually goes to other comprehensive income. Never ever take it to profit or loss. It goes to other comprehensive income. How much would that be? It will be a gain, and if it's a gain, you can put the negative sign there. Just do that. Remember, we decided everything related to assets to be negative, and then the liabilities to be positive. But just depends on what you need to do. So this is all about these issues. Now let me tell you one thing. In case you're told that the contributions are paid at the beginning of the year, that means this contribution should reduce this opening balance first. So this 40 here should first have reduced this figure here. If it reduces this figure, then you would determine net interest based on that figure. Yeah, if for net interest, we based on the initial figure because we presume that this contribution was made at the end of the year, right? Yes, so you need to understand something like that. Okay. All right, now let's go on. Proceed. Now they're just explaining each component in turn. I think you have spoken of that already, but let's just go deeper and understand. Okay. So here you have the net interest component, and I think I've already spoken. You know, when we say that you are paying interest, it's like maybe you have something for an investment, and actually it will take time, and so the interest will be earned to compensate for the time value of money, right? So that's why we say this is charged to profit or loss. We spoke about that already, and represents the change in the net pension liability or asset due to the passage of time. Simply speaking, it's due to time value of money. You know, when putting things in words sometimes becomes difficult. You may not be able to understand if they just say passage of time, but it's simple, a simple concept of time value of money. It is computed by applying the discount rate at the start of the year to the net defined benefit liability or asset. It's a very important point here. I'm repeating, discount rate at the start of the year. Right. Use the discount rate at that start of the what? Of the year, because it is based on that same liability or asset at the beginning of the year. So the discount rate should also be at the start of the year. In most questions, they give you two discount rates at the beginning and at the end. So you have to use at the start. Okay, and then you have another component, service cost component, and we already saw that. So as I told you, as for that service cost component, you can have current service cost, you can have the past service cost, and also you can have something that I just wrote it later. I said any gain or loss on settlement, right? We'll see all that. Okay, starting with the current service cost. Sometimes you can be given the question in the form of words. They do not just tell you this is the current service component. They give you in the form of words, and they should be the one to distinguish, right? To differentiate and understand whether it's a current service component, a past service component, or whatever. So as for current service cost, it's a current service. It relates to the current period. That's why we say it is the increase in the present value of the obligation. You know, as I told you and I showed you, the obligation is usually measured in present value, and the asset at the end is usually measured at fair value. That's why they speak of present value, present value. That's why the service cost will increase the liability. So that's why they say it is the increase in the present value of the obligation, which is the liability, arising from employee service in the current period. Over, right? Past service cost. We say that, you know, you can have something like this. Maybe an employee gave service in the past, but maybe there are some things that you have made. You have amended you have amended maybe the plan, and see that if you amend the plan, even those guys who did service for us maybe from 3 years ago, they can also get something. They need to obtain something since we have decided to change the system. So that's why we say it is the change in the present value of the obligation. That means it is the increase in liability, right? Maybe it could be a decrease, just depending, because, you know, for current service cost, it will obviously increase the liability, but for past service cost, it will depend. If it is favorable to the entity, it will reduce the liability. But if it is unfavorable, I mean, if it is unfavorable, it will then increase that liability. So just say it is a change in the present value of the obligation for employee service in prior periods. Why? Why can that change? The periods are already passed. Should they be relevant? Why do they change? This result from a plan amendment or curtailment. Do you see this? If you amend the plan or if you curtail the plan, you could find out that, oh, the, the changes should be reflected even back. And doing that, it would be beneficial to the entity or maybe it would be beneficial to the employees. So it will depend, right? And then you have any gain or loss on settlement. You know, when you settle something, maybe you have decided to pay employees. If you do pay employees, maybe let's say for the liability that was 80 million, employees just require 70 million. So if you just use 70 million, or maybe if you use the assets that are worth 70 million to pay 80 million, it means that you have obtained the gain, right? Yeah. So actually explanations just go on and on. And we are told here that past service costs arise when there has been an improvement in the benefits to be provided under the plan or when there has been a curtailment, right? Something like that. Let's say maybe there have been an improvement in the benefit to be provided. Maybe the benefits have increased, you have changed the percentage. Maybe it was 6%, but now the benefits have shifted to 8%. So it's obvious that an entity will have to incur much more cost, right? But also maybe when there has been a curtailment, you know, if you curtail, you can just say that, oh, I had, let's say I had 50 employees, but now in my plan, I only need to remain with 40 employees, so 10 of them are moving out. So if 10 of them are moving out, you know, if you curtail something, maybe it will really depend, right? Maybe you can say I've decided to shift them to someone else, or maybe I've just decided to remove them completely. So it will depend. That's why we say a curtailment is a significant reduction in the number of employees covered by the pension plan, and this may be a consequence of employees being made redundant. For example, maybe there are some employees we have made redundant, and maybe in the books they had a liability. There was a liability of 2 million, but you only have to pay 1.5 million. So you can say it's a gain on curtailment, right? Okay, so it's something like that. We still proceed with past service cost because it has something much here. But sometimes in exams it becomes very direct. So past service costs are recognized at the area of how do you recognize these past service costs now. It will really depend on how you do recognize them, right? It's either when the plan amendment or curtailment occurs, as we have just seen above here, it's either due to a plan amendment or curtailment, but it could be that when the entity recognizes the related restructuring cost or termination benefits, right? It could also be something like this. Maybe, you know, I hope you know about restructuring. Restructuring is related to I-37, provisions, contingent assets, and liability. Restructuring is among the provisions. So in case maybe the entity recognizes the restructuring cost, because as I told you, if you make a curtailment, maybe you decide to remove some employees, maybe you have done it in a large scale and there's kind of restructuring. So you can also recognize the past service cost like that at the area of that, right? So even if the plan has not been amended, or even if the amendment or curtailment has not occurred, maybe curtailment has not occurred, but you have recognized the related restructuring cost, you can be allowed to recognize the past service cost. And then you have settlement, right? You settle something arrives and then you settle. Now you see, we obtain the gain or loss. Now by settlement, we say settlement occurs when an entity enters into a transaction to eliminate the obligation for part or all of the benefits under a plan. So an entity just enters into a certain transaction. They just decide. Maybe you just tell another company, oh, maybe I have my employees whom I owe, maybe whom the plan liability is 10 million. But let us do this. You need money. Let me give you 8 million and shift these liabilities to you. Are you ready? If they accept, that means you have obtained the gain on settlement because you have settled a huge liability for a smaller consideration, right? That's why they say here, for example, an employee may leave the entity for a new job elsewhere, and a payment is made from that pension plan to the pension plan operated by the new employer. You know, so as to accumulate those pensions. You say that, oh, my pension was with company A. Now I need to shift to company B. So let me shift let us shift the liability. So it depends on how they agree. It may be that the liability shifted is actually 10 million, but maybe only 8 million is paid, and that will give a gain on settlement. So here we say the gain or loss on settlement is the difference between the fair value of the plan assets paid, because if you settle, if you have to transfer something to that other entity and extinguish the obligation, you transfer it from plan assets. So it's the difference between the plan assets paid out and the reduction in the present value of the defined benefit obligation. Simply speaking, the value of assets paid, you compare the value of the assets paid and the liability extinguished. If the assets paid are less, that means it's a gain. If the assets paid out are more than the liabilities, a loss, right? So the gain or loss forms part of the service cost component. That's why for that service cost, it could be the current service cost, it could be the past service cost, it could be the settlement. And that's why you didn't see that word settlement when I was writing there, or when this one was shown here. That settlement enters here, right? Settlement enters and that service cost component. So whether you have the settlement, you have the curtailment, whatever enters into the service cost component, right? Okay. So that's all about this. And then you have contributions into the plan. I think there's nothing much here. We said contributions into the plan, and most of the time it's cash. So it just goes and add the plan assets. So these are the cash payments paid into the plan during the reporting period by the employer, and this has no impact on the statement of profit or loss and other comprehensive income. Of course, we said that these contributions here just go directly to statement of cash flows, right? Do not compare to the defined contribution plan. That is amount paid already, so that's why you're taking it to profit or loss. But in this case, there is a way to determine the items to go to the statement of profit or loss, right? So learn to distinguish between the defined benefit plan and the defined contribution plan. Okay, as for benefits paid now, you're just explaining those components one by one, right? We actually we already saw that example. Okay, so benefits paid, how do you obtain these benefits paid here? It's something we just pay the benefits. We just use plan assets and settle plan liability. That's why we say that the amounts paid out of plan assets to retired employees during the period. And these payments reduce both the plan obligation and the plan assets, and this has no overall impact. We saw this already, right? No impact on the net value. And then we have the remeasurement component. We said that you compare the carrying amount and the value that which you obtain at the end. It could be gain or loss. I think you explained this already, right? After accounting for the above, the net pension deficit will differ from the amount calculated by the actuary at the current year end. Because we said we need the actuary at the end of the year. So that carrying amount you obtain is not final. You take the actuary determines the fair value of plan assets for you. The actuary also determines the present value of the liability for you, takes the difference and gives you the true figure. So you have to take that difference in the actuarial gain or loss or remeasurement gain or loss, right? So that's what you need to know. Explanation proceeding says the actuary's calculation of the value of the plan obligation and assets is based on assumptions such as the life expectancy and final salaries, or no issue about this. The question would explain this, but most of the times they give you already. Then you have the actual return on plan assets is different from the amount taken to profit or what? Is different from the amount taken to profit or loss as part of the net interest component. We said that already. The actual gain or loss goes to other comprehensive income, right? They have specified it here. It is charged to other comprehensive income, right? If they tell you it is charged, that means it's negative. It's a loss. But if it's credited, that means it's a gain. So it goes there. So you have to know that. And we are told that it identified as an item that will not be reclassified in profit or loss. So in case you have taken a look at a clear look at the income statement, As for those comprehensive income, they usually say items that will be classified will be reclassified and items that will not be reclassified to profit or loss. And this is something that will never be reclassified to profit or loss. It will just stay under other comprehensive income, right? Okay, we have the conceptual framework here, or I think we can just skip this. But maybe for explanation, we can just go through it. You can just go and take a look or what it states here. It's not bad, but it's no big deal in your case. Let me just leave it as for you to go through. Just like this. And this is a summary of the amounts recognized in the statement of financial statements. Yeah, it's just a summary. I think you wrote everything already. For service cost component, it goes to profit or loss. It comprises of what? Current service cost, past service cost, which could also include the curtailment, but also the settlement gain or loss, right? Then we have the net interest component. If we supply it comes from a net plan asset, it would be the income, net plan liability, it would be an expense. Other comprehensive income would have the remeasurement component, the measurement gain or loss, or sometimes called the actuarial gain. And for statement of financial position, we would have we have something called plan obligation, plan asset, and asset sailing. We actually are going to see this. It's a new concept. There's a new concept about asset sailing. As for now, just proceed as I told you. Okay. Now let's go and see this defined benefit plan. But no big deal. I think you did an example already, but let us just do another example. Now this example just gives you the net already. The question says the following information is provided in relation to the defined benefit plan operated by Celine. At 1st January 2024, the present value of the obligation was 140 million and the fair value of the plan assets amounted to 80 million. Do you see this? As for obligation, we use the present value, and as for assets, we use the fair what? The fair value. And this usually comes from the actuary. The discount rate at the start of the year, we are given 4% and 3%. Current and past score that goes to profit or loss there. Benefits paid, which usually have no impact on the net value. Contributions paid, they increase the assets. Present value of obligation at the 1st December and the fair value of planned assets. These figures come from the actuary. So if you take the difference, you can get the value from the actuary, right? Okay, take it as a second example. Required. Determine the net plan obligation or asset at 31st December at the end of the year. Net plan obligation or asset at 31st December 2024, 2025, and the amounts to be taken to profit or loss and the other comprehensive income for both financial years, right? Okay, I think as for net plan obligation or asset at 31st December, it's easy because we usually obtain that from the actuary's information. For example, if for 2024, you have an obligation of 200 and the asset of 120. So if you net them, you would get a net obligation of 80. If for 2025, it would be 230 minus 40, which is 90, also a net obligation of 90, right? As for the amount to the statement of profit or loss and other comprehensive income, we have to make the computation, right? Okay, so let's go to the computation and see. It's an illustration. You can just see it down here. Now do you see the statement of financial position? Just take the difference between plan assets and obligations. You have your 80 and you have your 90 here. Now let's go to this income statement. I think the income statement. Now, as usual, we usually, I don't know how they should have just written it as what we did at first. I don't know why they are doing this. Let's go to the working. No need yet. This is the point. You start with the obligation and asset at the beginning of the year, right? We had the figures here. Where are the figures? Those figures. Yes, the figures are here. At the beginning, we know that at January 2024, we know that obligation was 140 and assets was 80. So 140 minus 80 will have 60. And 60 is the net obligation, right? Yeah, so that's why if we start with 20x4 here, it would be 140 minus 80, which is the net plan liability. We set the liability for liability, we use positive figures. Then we usually determine the interest component, right? Net interest component. And how do we determine the net interest component? The net interest component actually I've been told is 4% for 20x4. I'm dealing with 20x4 right now, right? So 4% times 60. which gives us 2.4. And then we would have the service cost component is given out there at 30. We just write 30, it increases the liability. The net interest component would have the same sign as this net figure, which is obligation. Contributions into the plan increase the assets and so would have a negative sign to go against liabilities. As we said, benefits paid actually would have no impact here, so it's nil as you see here. Then you obtain the carrying amount, right? This will be the carrying amount. But we said that the net obligation at the end of the year was how much? We determined it here and said that for 20x4 it was 200 minus 120, which was 80. So you just go and take a look at your 80. 80 is our net value, which is here, right? 80 is the net value, which is that is here. Okay, after doing that, we compare your values. I have 60 plus 30, which is 90. 90 minus 25, 65 plus 2.4, 67.4. So you compare an obligation of 67.4. So what should you add or reduce from 67.4 obligation to obtain 80? That means I have to add an extra obligation of 12.6. And adding an extra obligation would only mean that this is the remeasurement loss, right? It's a remeasurement component, yes, but more accurately, it's a remeasurement loss, just like this. All right, yes. So that's for 20x4. You repeat the same for 20x5, and then you would have to reach at the answer, right? So actually, this net obligation of 80 at the end of 20x4 should be the one at the beginning of 20x4. It's like that. Service cost component was given there. No issue. Interest component is 3% now of 80, which gives you 2.4 again. And then you proceed with the contributions, would be positive like that. Benefits paid would be nil, and then you make comparisons again and you obtain this 5.6, right? So that's how we proceed with something like this. All right, so you really need to get such things. Okay, maybe we have something else here. It's speaking of past service costs. How do we deal with those? We are told here that an entity operates a pension plan that provides a pension of 2% of final salary for each year of service. Okay, no problem. Then on 1st January 2025, the entity improved the pension to 2.5. Now do you see, they have changed from 2% to 2.5%. There have been a plan amendment, right? We said there can be a plan amendment or curtailment of final salary for each year of service, including the first service before this date. That means the past service. So employees must have worked for the entity for at least 5 years in order to obtain this increased benefit. So it's for employees that have been at the company for the long term, right? And at the date of the improvement, the present value of the additional benefits at that same date for service from 1st January 20x1 to 1st January 20x5, that on that date is as follows. We are told here this figure, right? We are told here that employees with more than 5 years of service at 1st January 20x5 at that date, we have this figure here. This is the present value of the benefits. Employees with less than 5 years, right? We have 120. And this gives us a total benefit of how much? Of 270, right? Now take a look at the requirement. The requirement says that explain how additional benefits are accounted for in the financial statements of the entity. How are we going to account for those additional benefits? And we are told here that at the date of improvement, the present value of additional benefits are like this: 150, and then we have 120, right? Okay, how do we deal with that now? This is what we do. The solution says the entity recognizes all 270,000, right? Immediately is an increase in the defined benefit obligation following the amendment to the plan. Do you know why we did this? We did this, we are doing the past service cost. So if it's a past service cost, we expected it to have been included in the past periods. But since we have known it all right now, we can just include it all, right? So that's why we say this will form part of the service cost component because it's about the plan amendment. We said the past service cost would be due to plan amendment or curtailment, right? So this will form part of the service cost component. Whether or not the benefits are vested, it doesn't matter whether it's time to pay the benefits or not. That is what it means by whether they are vested by the reporting date is not relevant to their recognition as an expense in the financial statement. I think we know that we have seen under IFRS share-based payment, right? It's for the expense you just recognize. Maybe for the actual payment may not have been yet to be done, but you still have to recognize an expense, right? So that's what you usually have to do. Do not say, oh, I cannot recognize this and right now. No, you can just do that, right? Yes. So that's all about this, and maybe you could have some other examples because we said that it comes from the plan amendment or plan curtailment. Now, what of that plan curtailment?